Good morning, everyone, and welcome to Maintaining and Maximizing Commercial Real Estate Value During Uncertain Times. We are so glad to have you, so thank you so much for attending. A few quick housekeeping items we wanted you to be aware of. This webinar will be recorded, so if you need to go back and look at it again, we will be sending you the link to the recording along with the slides later today. Full disclosure to all of you, Zoom has been a little cranky this morning with our presenters and team. So if for some reason it acts up and we can't finish, we will go ahead and record this and send all of you the link. And we'll also provide a way for you to send us questions that Gary and John and the panel can give ahead of time. But so far, so good, so keep your fingers crossed. I also wanted to let you know that we will be taking questions throughout. So if you go ahead and hover your cursor to the bottom of your screen or to the top, a little Zoom bar will pop up, and put your questions in the Q&A box, and we'll be monitoring those throughout the presentation. So now I would like to go ahead and hand it over to my partner, Jon Huckabay, to get us going. Take it away, Jon.
All right, thanks, Jill. Hi, everyone. I'm Jon Huckabay. I'm a tax partner with LSL CPAs. We are a full-service accounting firm offering assurance, tax, and business advisory services to closely held small and middle market businesses. And we're proud to say that we are currently the largest CPA firm based in Orange County. So with that, now I'm going to introduce our presenter and our lender panel for today. First, our presenter, Gary Martinez with Ashwell Associates. Gary is a commercial real estate broker with over 20 years of experience. He has successfully completed over 2,500 transactions and has represented various investors from Fortune 100 companies to family-owned operations. Gary is proficient at providing investment analysis, maximizing cash flow, maximizing commercial property values, and finding the right property at the right time. Gary holds two of the most prestigious designations in the commercial real estate industry, Certified Commercial Investment Member and Society of Industrial and Office Realtors. Our lender panel today is composed of Michael Nasser. He's a loan officer with Southland Economic Development Corporation. Michael specializes in helping business owners understand the SBA underwriting process and requirements for lending. He works directly with all the banks that participate in the program, mortgage brokers and commercial real estate brokers representing their clients. He has been with Southland EDC since 2012, assisting business owners with obtaining financing through the program. Next, we have Ali Chawla with Chase Bank. Ali has over 17 years of business banking experience in various roles. In his current role, he takes an advocate role for his clients to all channels of services offered through the bank with an objective to simplify their day-to-day banking while protecting them from fraud. Ali acts as a partner to his clients to understand their current and unperceived needs and presents solutions to help them grow their company by taking care of all their working capital or capital expenditure needs. And lastly, we have Rick Rowley, Vice President, Citizens Business Bank. Rick has over 39 years in commercial banking and servicing middle market companies in the greater Los Angeles area. He specializes in providing working capital and commercial real estate loans. Okay, and with that, I'm going to pass it over to Gary for his presentation. He has a great presentation for you guys today in maintaining and maximizing your commercial real estate value during these uncertain times. All right, Gary, take it away.
John, well, thank you so much. Can you hear me okay? I know it seems a little crazy this morning. You hear me fine?
You sound good.
Perfect, wonderful, thank you. And thank you everyone for participating as well. I just really quick, just want to go over today's agenda. The very first three items that you see right there, market overview, goals to maintaining, maximizing property value, guidance to working with tenants, is a presentation I put together for everyone that's a part of this discussion today. After the presentation, that we're going to get into the insights and give you some advice and suggestions from a lender panel, and then after we're going to go into a Q&A section. And so if you do have a question, I would encourage everyone to use the Q&A box, as Jill mentioned earlier. Go ahead and type in your questions, and we want to make sure that we answer everyone the best that we can, because we're all here for our attendees. And so first, maintaining and maximizing commercial real estate values during uncertain times. As we all know, COVID has really created a lot of challenges at this time, which has created a lot of uncertainties. And so we want to make sure that we're providing information to property owners on what they could be doing with their property owner, again, which is to maintain their cash flow and to maximize value, because there are opportunities that can be done during this time. So what we did is we put together a step-by-step program on how a property owner could do that. And we're going to go over into each of these into a little bit more depth, but just as a quick overview, we're going to talk about, remembering your investment goals. We want you to know your property value and how it's determined, which is very important to understand, in all times of the market. You want to know your tenants and the market. And number 4, we're going to talk to you a little bit about maintaining and maximizing your net income. And this is the portion where we talk more about how to handle any tenants that are coming to you for any rental concessions. One of the things that you want to try to remember during this presentation is you really want to try not to lower your rent, because remember this, if you lower your rent, you're going to lower the value of your property. So that's going to be a theme that we're going to see throughout this presentation. So,
Excuse me, Gary, can you just speak up a bit? Can you yell a little bit so that we can hear you a little better? It's a little faint.
okay. Am I a little faint? Okay. Is this any better?
Yes.
Okay, perfect. All right, let me try to keep this a little closer to me and speak up. And so thank you for that. Okay, so regarding uncertainty, and uncertainty at this time is the biggest challenge. And so we naturally know we're all dealing with COVID, and we don't know which direction COVID is going to take us at this time. But COVID has created issues and challenges as far as lots of jobs being lost at this time. We have elections that are coming up. We have an uncertain global market, and all of this really creates into a lot of uncertainty for our personal finances. And usually what we find is that when we have uncertainty, we have folks that typically tend to freeze. So when we freeze, we start to feel like we're stuck in the mud, and opportunities start to pass us by. And that's what we do not want. We want to make sure that we're aware of the different opportunities that are available to us at this time. So we make sure that we don't freeze and get stuck in the mud. And so what we want to do is we want to create certainty in an uncertain market. And how we do that is really by anticipating. There's no way that we could really control COVID. However, we could control on how we manage and how we deal with the aspects particular in our property. And how we do that is we want to look at our existing tenants and understand the businesses and the industries that they are in. We want to understand the market and with the directions it's going up and down. We also need to understand what's happening to us locally and how all of this could affect our personal finances. And so, Jill, can you hear me okay?
Yes, Gary,
right,
but keep it loud.
Keep it loud, okay. If I get faint, let me know. All right. So with that, let's get into number 1. We want to remember your investment goals, and remember you purchased the investment property for a particular reason. And the reason may have been for cash flow. May have been for the expectation of the value of your property going up. It may have been for tax incentives, or may have been because it's cheaper for you to own the property than it is to rent. And so whatever your goals were that you had in place when you first purchased a property, we want to make sure we keep these in mind. And one of the challenges that we find a lot of is that when we start talking to a property owner and start getting on the property, and we start to interview them and get a better understanding as to what they've done on the property and what their expectations are, we found is that they're really lost and that there's really no plan or really goal in place. And so we want to make sure that we keep our goals in place. And we especially do not want to let COVID get in the way of what our plans and our goals are. And so step number 2 is we want to know your property value and how it's determined. Now, this is a very important aspect as we're looking at property valuations, because this gives us an idea of the different lenses that property owners are using as they are looking at not just property owners, but any potential buyers or lenders, or even for yourself. But these are important lenses to look at as we are looking at valuations for your property. And so there's basically 3 different lenses that we look at when we're trying to determine property value. And it's important as a commercial real estate owner or an owner of an investment property that you understand the values of each of these approaches. The comparison approach is an approach that a lot of us are very familiar with. This is the approach that's mainly used for residential. So what is like a typical 3-bedroom, 2-bath house go for in a particular neighborhood? we start to see that data enough, we start to get an idea as to where those valuations are at. And so, but we could also do that same approach with commercial properties. Replacement costs, we got to certainly understand replacement costs. And replacement cost is by understanding the value of the land that the property sits on, and what is it going to cost to replace the structures that are on the property. You blend the two together, you get a replacement cost. If you're interested in know the replacement cost, usually your insurance company could give you an idea as to what the replacement cost would be for your property. They won't know the land cost, but they at least tell you what the replacement cost is for the structures. And the income approach is really we're going to spend more of our time on. And so, so this may be a review or an intro, for a lot of us as we're looking at income approach. But we want to make sure to remember this diagram, which the diagram is essentially a circle with the line up on top, or line right in the middle. What up on top is the annual net income, and below that is the value and cap rate. So how this works is if we know an annual net income of a property, let's just say it's $60,000 for the year, and let's just say there's a cap rate of 5%. And just as a reminder, what a cap rate is if you own the property 100% cash, there's no debt in place. This is essentially your return on your property. And so understanding the cap rate, what's happening for your particular property in your particular area is very important, because the cap rate will move depending on the property type and your location. But just for the sake of discussions here, I'm just using a 5% cap rate. So again, let's assume there's a $60,000 annual net income. We're going to divide that by 5%, so it's going to give us a valuation of the property of $1.2 million. Okay, so let's just say hypothetically you were able to generate an additional about $180 a month, which generates an additional $2,000 a year for you. So again, using the same mathematics, 62,000 divided by 5%, essentially what you did, you raised the value of your property $40,000, which is really important to understand this concept as we are working with tenants and working with the rents that we're collecting. Because this also works in the opposite direction. So if we have a tenant that is looking for some type of rental concession, things are not going as well, and we feel the need to lower their property or their rent, let's just say by $180 a month, which affects the value or the annual net income, for the year by $2,000, which takes it down to $58,000. So again, dividing it by 5%, essentially by us trying to be a good landlord and helping out our tenants, we're lowering the value of our property. And so this is why we talked about earlier, what you really want to try not to do is lower rent, because whenever you lower rent, you're going to lower the value of your property. And this is true as you're looking at new leases. So if you have a new tenant that's coming into your property and wanting to rent your property, you have a lease renewal, or again, you have a tenant that's looking to renegotiate a lease, going through this exercise is really important, because what you do with that lease is really going to affect the valuation of your property. Okay, step number 3, know your tenants and the market. Okay, so here's the area where we got to understand what's happening in the market, and essentially we have to do a market analysis. And so we're going to give you some data here to kind of help give you a better idea and a sense as to what's happening out there in the market. Okay, the first thing that I just want to share is employment. And so one way we could dictate as to what types of tenants and what type of industries that we should be focusing on and trying to rent our businesses to, or our spaces to, here's some industries and some businesses that may be good for us to try to target into our vacant spaces, assuming we have vacant spaces. And it doesn't necessarily mean that they have to be specifically in the industry. They could also be associated with the industry. For example, earlier this year, right when COVID started, we have a lot of clients that are in downtown LA that are in the produce, markets. And, by talking to one of those clients, and what we found is that, especially during March, April, when this whole COVID stuff started to hit here in the United States, where things started to shut down, when I gave one of my clients a call, it was very difficult for me to get him on the line because he was just so extremely busy, trying to give produce to all the markets that were, for looking for produce at the time. the following day, I called another produce company, again, same industry, and that particular client was extremely slow, and a lot of worry and a lot of uncertainty you could hear in his voice. Well, the main reason, and again, they're both in the produce industry, but the main reason is because the company that was supplying produce to the markets was extremely busy during that time, versus my second guy, he was supplying produce mainly to restaurants. And so, again, understanding your tenants and the industries that they are involved in and the customers that they serve and the industries that they serve are really important as you're looking at your tenants. And so it'd be a good idea to look at a rent roll and analyze and look at each of your tenants and communicate with them as much as you possibly can so you have a better idea and sense as to what's happening in their world. So these are good businesses and industries to focus on. But there's also some industries that are, as we all know, we hear consistently, that are struggling. And these are more of the tenants that we hear part of the news, such as clothing, arts, leisure, hospitality, restaurants. We hear all over the place. And so, again, if you have businesses that are in these industries or associated with these industries, there's a good chance that they are struggling. And these are probably the industries that are going to be probably going to you, most often if they're looking for any type of rental concession. And so, also want to give some awareness to some honorable mentions or some industries and some businesses that have actually taken a hit but have actually been coming back. And I think as we are starting to get a better understanding as to where we're at during COVID at this time, these are good industries to look at and to focus on. And you can see quite a few of these folks here are in the retail sector. So if you do own a retail property, these are industries and businesses that it would be good for you to focus and to target on, because again, these are businesses that are growing at this time. And so, another thing having to do with market analysis, we want to share this slide here with you. I thought it was very interesting, and this is the quarterly business applications. And so we think of all the different layoffs that have occurred, within the past few months. And so, we have a lot of people here, in Orange County and the United States are very resilient and will not take no for an answer, And so what we've seen is a big spike in business applications, and so this is important to understand. At this time, there's a lot of businesses that are being formatted and being generated and started at this time, and we could see it here clearly by the slide. Now, if we think about where these businesses typically start, they typically start in the garage. They start in a bedroom of one of their in their home, and I think this is part of the reason why we're seeing the residential market being in such a big strong demand along with the low interest rate environments. But we think about again of all the businesses that have started during this time, when they outgrow their garage, they outgrow the office, or they can't. They're finding that they can't work functionally within their place of being at home. What they typically do is they start looking for commercial properties. They start looking for a small warehouse. They start looking for a small retail location. They start looking for a small office. And so if you are an owner of any of these types of properties, really focusing and trying to demise larger space into smaller space is an area where you have a good opportunity and a good traction, to pull some tenants. Another thing to keep in mind, again, if you own property here in Orange County, is Orange County that we are in the red when it comes to California's reopening risk tiers, which is a good thing for Orange County because that means more businesses are open or they're allowed to have more people in their place compared to Los Angeles or Inland Empire that's in the purple, where these areas are still having a lot of businesses that can't function and can't make money like the way that they intended to. So what we're starting to see, especially in the cities that are along the 605 freeway that border Orange County and LA County, is that we're seeing a lot of spillover of businesses wanting to rent in Orange County. And we're getting a lot of calls from like flower companies, chiropractors, beauty salons, nail salons, and we're receiving multiple offers for some of our retail space. And a lot of it has been coming from businesses that were in LA and wanted to come to Orange County because they just want to open up and they want to just start making some money. So So key takeaway here on this slide is again, if you have any vacancy, focusing on businesses that are in the LA County region will certainly help, create some attention, some traction towards your properties as well. Here we're going to go into each of the sectors a little bit more specifically: industrial, office, retail, along with multifamily. So not exactly sure what what everyone owns here on that's participating in this presentation, but we're going to give a little highlight on each of the sectors. And so industrial, we're not going to spend a whole lot of time here. Only thing I got to say, if you own industrial property, congratulations. Industrial has really been the main sector that's been continues to boom during this time. We have a lot of buyers that are actively looking for industrial space. The biggest challenge with industrial is just the availability is so scarce. We just can't find anything. And when a property does come on the market, there tends to be multiple offers. One thing that's very interesting and kind of a head scratcher for me, because I see these prices every day with industrial, is we're starting to see industrial prices start to get above $300 a square foot. And so becoming pretty expensive. And then we think about, replacement costs, as we talked about earlier. Replacement cost for industrial is pretty cheap. If we think about an industrial building and how it's structured, it's structured with concrete tilt-up walls, or concrete walls that are tilted up, and all they do is put a roof up on top, and voila, you have an industrial building. Compared to a retail property or an office property, and we think of all like the carpeting, the flooring, the lighting, the T-bar, and everything that's involved in that. It's much more expensive to develop and to construct an office building and retail building versus industrial. However, industrial property prices are in a lot of cases higher than an office and a retail property at this time. So again, if you own industrial, congratulations. Just continue to stick with it because that is a good sector to be in. There are some challenges within industrial, however, and the main challenges are having to do with R&D space and flex space, and a lot of spaces that we see like in the Irvine area, where it does have a good portion of it office and a small component of it being warehouse. Those types of industrial properties are not flourishing as well as the warehousing, manufacturing, and distribution buildings. However, those are still, running strong as well. Office sector. Okay, we've had a major exodus of companies leaving their office space and working from home, and so this has been created a real challenge. And so we can start to see some real numbers here. So we see the area that's highlighted in yellow. So we could essentially see the first 3 quarters as to what's happened here in 2020. And what we've seen with the office market, vacancy has been increasing, and rental prices have started to decrease. So as we talked about earlier, whenever you drop your market rent, essentially what you're doing is you're dropping your property value. And we almost have to drop rent. We got to think about dropping rent, especially when there's so much competition and vacancy that's out there in order to attract a tenant. But if we go back and think about all of the new business applications that have been submitted, and we think about all the new businesses that are coming out and looking for office space, the hot sector with office is really executive office suites. We have a multi-tenant office building in the city of Orange, and it's been the past couple of months where we're getting calls every single day of people wanting to rent out our small executive suites. And what a small executive suite is, essentially, it's just basically a room where someone could go out there and just put a desk and their computer and a phone, and off they go. And one thing that's interesting with these executive suites is that we're getting anywhere from $350 to $550 a square foot. Where a normal office building, we're lucky if we get $1.85 a square foot these days. So if we talk about increasing cash flow, increasing valuation of the properties, if you do have office space that you're able to demise and make a little bit smaller and rent out small rooms, it is going to create a little bit more of a management headache. However, at the same time, you're going to dramatically increase your cash flow and increase your property value during this time where there's a lot of uncertainty. And so So here is a slide, again, having to do with office and office sales. We can kind of see as to what's been happening this year as far as office sales. I mean, office sales are continuing to happen during this time. And this report here is coming from CoStar, and CoStar is projecting that prices on office buildings are going to start to drop in this quarter that we're in, and they'll continue to drop next year. Which I could see that, more for investments, but again, if you're a property of office buildings, you do not want this to be any of us. And so we want to make sure that we're doing the things that we can and taking the steps that we can in order to make sure that we're not losing value, that we have the opportunity to maintain it and to maximize it. Retail. We saw a lot of the businesses that we shown earlier. A lot of them are in the retail sector. And this is a little scary. And as we look at the yellow area and we start to see vacancies, well, we're seeing a lot of vacancies in the retail market, and we're seeing a big drop in rental prices. And so, as we hear on the news of commercial prices dropping, I think really what they're talking about is really more towards the retail sector, because there is a real challenge with restaurants. There's a real challenge with clothing stores. And a lot of other type of medical users, such as a dentist or a chiropractor or surgeons, and that focus more on cosmetics than having to do with more serious surgeries. But the retail sector is really damaging. And so again, if we think about the businesses that have been doing well during this time, we think about the sporting goods stores. We think about car sales, auto repairs. I mean, all of those types of businesses are doing extremely well, and they are growing at this time, especially if we think about like the tradesmen. It's very difficult to get an electrician at, someone's house these days because they're all so busy. Well, those folks are looking for showrooms, especially if they sell some type of kitchen cabinets. A lot of them are looking for showrooms that they can open up a small location, to continue their success and growth that they've been having with their business. And so, if you own a retail center, those are sectors and properties to be looking at, and because this is a real trend that's happening right now in the retail sector, and we do not want any part of this. Okay, multifamily. Let's get into multifamily really quick. Multifamily, we could see in this past 3 quarters, we did see a spike in studios vacancies. And we think about all the college students that had a studio, when COVID hit, and then essentially their school was closed. We did have a lot of college students leave their studios and go back home or disperse wherever they would typically go, along with young professionals going to go live with family members or going to go find a roommate. And so, but one thing that's interesting, having to do with multifamily, it is very resilient. And so there was the National Multifamily Housing Council surveyed the largest property owners across the country, and this is having to do with rent concession. And so what they found is that the percentage of rent that was paid for the month of October 2020 was exactly the same of the rent that was paid in October 2019. So what that means is that rent is continuing to be paid. COVID really hasn't created too much of a negative effect as far as receiving rent for these property owners. I think there's a caveat there, and that's having to do with the stimulus checks that were given to essentially most people. And so we are expecting another round of stimulus, and we think that's certainly going to continue to help in the multifamily sector as far as folks paying rent. But I think really a big unknown as to what's going to happen if that stimulus doesn't occur, or if it's just what's going to happen in the long run. And so, but I think overall multifamily has been a really good sector to be in if you own multifamily. And we can see here, these are sales. These orange lines having to do with sales, the amount of sales that's happened. There hasn't been a whole lot of sales, we know, in 2020 having to do with multifamily, specifically in Orange County, because of the moratoriums and everything else that was put in place. There's a lot of unknowns, but we are seeing that sector, being very attractive again. Okay, and so that was step 3, essentially your market analysis. Okay, so we're going to go to step 4, and this is really having to do with maintaining and maximizing your net income. And this is kind of our play-by-play that we gave all of our property owners back in March, as far as how to deal with tenants that are going to be approaching them with with rental assistance. And so, LSL had a talk yesterday, a webinar yesterday, specifically on how tenants could be working with their landlords, to get rental concession, and they had a good turnout, which tells us, there's a lot of businesses that are still struggling at this time and maybe approaching property owners and maybe approaching us looking for a rental concession. So this is a play-by-play that you could follow and you could do if one of your tenants come to you and are asking for some type of rental concession. So number 1 is listen to your tenant. I think by far, out of all these steps, this is probably the most important step that we cannot miss. And so what we need to do is we need to listen to our tenants. And so we got to remember, if our tenants are approaching us, there's probably a level of anxiety that they have, and worry and concern. And sometimes they just want to be heard and listened to. And so what I tell all our clients is just listen to your tenant, let them talk as much as they want, because sometimes all they got to do is just get it off their chest. Once they get it off the chest, it relieves the anxiety and it puts them back at a state where they can start thinking a little bit more logically. So we got to listen to our tenants. Number 2, after we listen to our tenants, what we want to do is we want to share our plan. We want to let them know that we're all affected by COVID, and that you are also doing your part as a property owner to make sure that they and their employees and their vendors and visitors are also being protected. And let them know what you're doing. If you are increasing, the amount of times that you're having janitorial service, or if you have done anything to your property to make it more clean, if you put markers on the floor to order traffic to go in a certain way, walking traffic to go in a certain way. Let them know what your plan and what you've done at this time. Number 3, and I found with our property owners, this has probably been the biggest challenge that they've had, which is requesting financial information. And it could be a little uncomfortable, I must admit, to ask your tenant as to getting financial information, especially if they're telling you that things are very difficult for them at this time. And so what we tell our clients is making sure that we tell the tenants and apologize to them and say, I'm sorry, this is, any tenant that comes to us looking for any type of rental concession is, our partners have put together a policy that we just require to receive financial information. And the information that we're looking for is your past, 3 months of profit and loss statements, and we want to see last year's tax returns, because we want to be able to compare as to what's happening last year and what's happening today, and really getting a really good sense as to, really what's happening financially in their business. And so what we found is that a lot of tenants have stopped here, have not shared that financial information, and just continued to pay rent. And it's probably because they're not in a real dire need as they initially projected. Okay, number 4, we want to request an offer from the tenant. We don't want to guess and assume that by giving them some free rent or giving them whatever it is that we think may be helpful for them, we just don't want to offer it to them, because whatever we offer them, I could guarantee you it's going to be wrong. And so we want to make sure the tenants are the ones that are giving us the offer. Number 5, we want to communicate with the tenant. And again, kind of going back to number 1, we want to make sure we're giving them feedback. If they call us, we want to get them on a phone, very quickly. Again, a lot of anxiety is happening during this time. We want to make sure that they're not making irrational decisions, like skipping out in the middle of the night and not paying your rent. We want to make sure that we're communicating with them consistently.
A little louder, Gary, you're dropping a bit.
Am I dropping a bit? Okay, is this
Yeah,
better?
just a little louder. Thanks.
All right. Sorry about that. Okay, so then number 6, we want to come to an agreement. So in the event that we do come to some type of agreement with them, these are some concessions that we could think about doing that really shouldn't affect your value of your property, too much, as long as we don't, overdo it. but maybe essentially we want to, think about giving them some free rent. Maybe for the month of November or month of December, we'll give them, either free rent entirely or maybe for a portion of it. Maybe we want to talk about terminating their lease early. If we think about the different industries that have been essentially fell off a cliff, we have to know when we got to cut our ties and just let them get out of the lease early. We want to talk about rent deferment. So let's say in the month of November where we get that rent and we spread it out the remaining term of the lease, is a game plan that, if everyone could agree on that, then, rent deferment could be a possibility. We want to think about doing what's called a blend and extend. So this is an event where you have a tenant that the lease is going to be coming up, let's say in 6 months. And they're asking for some type of rental concession, 1 or 2 months of free rent, and they really need it. And so essentially, we don't want to give them a free rent and have them bail on us, in 4 months later. And so in this case, what we want to do is we want to, think about extending their term of the lease along with blending the terms, the new terms that you're offering them, for as a rental concession. You also want to remind them that they have the ability to sublease. So most commercial leases give the ability for the tenants to sublease their space. Naturally, they would need to get approval from the property owner, but you want to take them to the section of the lease agreement that talks about their ability to sublease. Number 7, you want to step away. You don't want to make a decision right there on the spot as you're talking to the tenant. What you want to do is you want to step away, and you want to get back to them very quickly in a timely fashion. And you want to tell them specifically what it is that you decided to do. And number 8, there's a lot of SBA government assistance programs out there that we heard with EIDL and PPP. We want to make sure that we're giving the tenants that information because they may not be aware of what's available out there. So we want to make sure that we are aware ourselves, and we want to make sure that we send them to those websites and those proper assistance areas because those are assistance that are specifically there for their type of businesses. And so with that, as we're going through this, and we want to remember, try as hard as you can not to lower your rent. You want to try to be as creative as you can because remember, if you lower your rent, you are devaluing your property, and that's one thing that we really do not want to do at this time. And so with that, there's our little step-by-step program, just kind of a high overview, what property owners could be doing, on their properties to making sure that they're maximizing, their cash flow and the value of their property. Number 1, remember your investment goals. Number 2, know your property value and how it's determined. Number 3, you want to know your tenants and the market, which is the market analysis. And step 4, the steps that we've given you how to handle either new tenants that are coming in or tenants that are looking for a rental concession. And remember, we want to try not to lower rent. And so another aspect we're thinking about net income is we want to remember money is cheap at this time, and we want to take advantage of this money that's out there. I recently refinanced my house. I'm at a 1.875 for a 15-year fix. And there's a lot of commercial programs out there where interest rates are extremely cheap. So if we think about net income, again, if there's a way you can increase net income, one way you could do it is by lowering your expenses. And refinances and purchases of property right now could be amazing. And so that's what I have here as we're going to bring in the lender panel. We have some amazing lenders that are part of the panel. I'm very excited. All of them are here. I've had an opportunity to work with each of them. I can tell you each of them are very well experienced and are generous. Have been very generous to give us their time and also some insights on how we could be taking advantage of today's market. And so we have Michael Nasser with the Southland EDC, Ali Chawla with Chase, and Rick Raleigh with Citizens Business Bank. And so I'm going to stop sharing here, and I'm going to go ahead and bring in our panels. And just as a reminder to everyone, if you have any questions, go ahead and use the Q&A box, and we'll make sure we get to them before we log off here. So with that, lenders, are we here? Rick, Ali.
Yes, I'm here.
Mike, all right. Well, thank you so much for your time. Thank you, everyone, for being here. And so, just if you can, just real quickly, kind of tell us what you're seeing out there in the marketplace. I mean, Michael Nasser, what are you seeing out there right now at this time of COVID, and what are businesses saying, and what are some opportunities that are out there?
Yeah, so again, thank you guys for having us. To answer your question, Gary, is SBA is just having their biggest volume they've ever had. Whether if someone's purchasing or refinancing, at the end of the day, lenders and also borrowers are looking at ways just to overall reduce their risk, and how they do that is through SBA. So the SBA helps the bank reduce their risk on their balance sheet. Also, too, taking advantage of SBA, we're able to offer longer term fixed rates. And just to give you an idea of where the market is at, I mean, we're right now our 25-year fixed is at 2.56. So that's why our industry is so active right now. Is people are wanting to take advantage of that rate, whether through a purchase or refinance.
Yeah, so I'm going to go to the same question, Ali, but just to let all our participants know. And so just Michael Nasser, I mean, you're here really representing SBA, which is owner-user, which an owner-user just only needs to put 10% down. Ali, you're more of also owner-user, focusing on businesses that are looking to buy their properties, conventional financing. I know, Chase also has SBA and the financing program, but you're here specifically to talk to us about owner-user deals. And Rick, you could do all of it as well, and your bank is certainly amazing also, and you're here more specifically to talk to us about investments. And so just for our participants, and that's kind of how we put together our lender panel here. So with that, let me go to Ali. Ali, what are you seeing out there at this time in the marketplace?
First of all, thank you so much. I appreciate the opportunity to speak to everybody here. But the current rate environment as it is, both refinance and purchases are lucrative options. I have done more and more break-even analysis to determine, okay, what's the interest cost saving to recoup the cost of refinance, as well as taking another opportunity to reassess the customer's objective to put a new loan structure to meet their long-term goals. In an instance recently, I fulfilled a refinance where we reduced the rate by 0.25%, but we were able to extend the term another 15 years to mitigate future interest rate risk for this client. Subsequently, if you're leasing, it's worth doing a lease versus purchase analysis. In a recent scenario, I've uncovered that monthly carrying cost of buying to leasing is very similar. In this particular scenario, I actually leveraged Michael Nasser's group, and we required only a 10% injection. So in summary, both purchase and refinance are lucrative options, and it's worth having a conversation.
Rick, same question to you. In the investment world, what are we seeing as far as investments? Is it becoming more challenging for an investor to purchase a property, or are there certain property types that are a little bit more challenging these times than others?
Well, in terms of the property types, as you mentioned in your presentation, the retail space, especially the restaurants and the retail centers and the hotels, those are hard for us to finance. It's not that we can't, but if we do, it's highly dependent upon the financial capacity of the owner and also the tenant. So the multifamily space, it's being impacted by COVID as well, and that's relative to rent control and non-payment. So once again, that space, we're also looking for the financial strength of the tenant and the guarantor. You've mentioned that industrial is a safer space. We're finding a lot of owner-user activity, and basically it's refinance with cash out. And I think that primarily that cash out is for two things. One, to increase the net worth of the company so that it's less leveraged and allow it to be more flexible. And number two, to put in equipment or leasehold improvements. That's basically what we're seeing. I think the thing that's not been mentioned is the Prop 15 wild card.
Yep.
If that Prop 15 gets passed, that's going to impact the real estate market in a significant way. And we don't know exactly what will happen, but we're also watching the polls for that activity.
So, yeah, thank you for that. That's something that's very they were paying very close attention to, it could be very scary, that Prop 15. And so, thank you for mentioning that, Rick. And so, now, what about down payments? During this time of COVID, and so has COVID really affected the requirements for down payments at this time? Is it much higher? Is it the same? Is it lower? I'm going to ask you, Rick, then I'm going to go to Michael Nasser next with that same question.
At our bank, it is something we're really looking at. Right now, we are primarily interested in a 65% loan to value. In the past, it was closer to 75. Now, we still will go to 75, but it is a factor that we're considering. Yes, very, very important.
Okay, and then Nasser?
Yeah, so great question. So my answer will be based on owner-user property, where a business is using at least 51% of that space. So with that, I saw a question in the group. So the purpose of our program, the SBA 504 loan program, is to leverage 10% down, so a total of 90% financing. With that, if it's just for example, that question was posed, is a commercial lot, let's say if there's no structure there and if it's used for transportation businesses, 10% is still okay. Regular commercial properties that are non-hotel, non-gas stations, non-car washes, 10% is down. And that's the purpose why banks are leveraging SBA, is so they can offer their borrowers 10% down payment, whether if it's 90% financing on refinance or 90% financing on purchases.
Yeah, that's good. And Ali, I mean, we talk about COVID. I mean, how can you talk about real estate and talk about anything without talking about COVID at this time? Now, how has COVID affected your bank and maybe affected the underwriting process of if a company is looking to purchase a property? How has COVID affected the underwriting process, or any new documentation that's required at this time?
This is a good question, Gary, and it certainly has. The bank is requiring us to do more due diligence on the front end, and when I speak to the process, I'm talking about owner user. So in essence, looking at the company financial statements, it's really to determine, okay, well, what are the true impacts of COVID-19 to the company, and what if the impacts are bad, what does the recovery look like for them? Talking about additional documentation, depending on how that answer is delivered, we may require some projections to see what the recovery will look like for the client. Subsequently, if the company has been impacted on the positive side, we want to make sure that it is sustainable.
And so here's a question for each of you. I mean, we hear a lot of businesses that are going out. Are you seeing challenges with the book of business that you have in your portfolio? Or are you seeing businesses that are, falling behind? And are we starting to see more foreclosures on commercial properties at this time, based off your experience? I mean, it's a question for all of you. Have any of you seen that?
I've seen that in. I've seen that in the restaurant space, that those people have really had a hard time, and we haven't had foreclosures, but we've got them in a very we're very concerned about that portfolio.
Nasser?
For us, it's been like fitness centers. We have some clients that we have provided financing to that we saw were hit hard. We saw revenues die down again, like Rick said, for restaurants. But fortunately, in our book of business, restaurants were still able to make their payment even after the SBA CARES Act relief ended for them.
And so we saw the slide earlier that we shared as far as new businesses being started up at this time. and there's certainly a lot of businesses out there that would love to take advantage of the low interest rate environment. Is there an opportunity, say, for a startup company to get financing at this time, Ali? Is this challenging for them, or what do they need to provide in order to make that happen?
I would say it'd be more challenging now than it was before. But every opportunity is unique, and every sponsor is unique. So we would want to take it case by case. In a startup scenario, we would leverage our SBA partners, where we could rely upon more of their business plan and projection versus looking in the historical cash flow. But to answer your question, Gary, it is tougher now than it was before, but it's not a hard no.
And what about collateral? I mean, are banks using extra collateral at this time? I mean, are they requiring any additional things back in their loan, or is it becoming more important at this time, Rick?
Well, as I mentioned, the collateral itself, we're reducing from a 75% to a 65%, meaning requiring more collateral from the property itself. We also, as Ali had said, we're looking at the underlying companies, the tenants, more carefully now than we were before. They won't provide a collateral support, but it is possible that from the guarantor point of view, if there's a shortfall, we would obtain additional collateral from them, either real estate collateral or cash collateral or something else. So to make the deal work, because we're at a lower loan to value, additional collateral sometimes is required to make the deal work.
And Nasser, is there any requirement changes on the SBA side?
It just depends on the program. So the two main programs are an SBA 504 loan program, an SBA 7A loan program. The rule of thumb is if you're applying for an SBA 7A, whether for a purchase or refinance or debt structure, traditionally, the lender is going to require additional collateral in the form of other real estate. For the SBA 504 loan program, that program 99% of the time does not require additional collateral. The reason why I say 99% is if we're dealing with a ground lease, that collateral requirement does change on there.
That's great. And Ali, we talked about businesses that are actually doing well, during this time of COVID, and businesses that have found their place and are making money. What industries and what businesses are you currently working with, or have you seen that have turned the corner and are doing well at this time?
Me personally, in my portfolio, these are a variety of companies that were in somewhat of a retail sector. They've now pivoted more towards an e-commerce approach, and that they've benefited greatly with more sales. But at the same time, these rapid growth brings in different type of challenges to the companies, and these are some things that we still need to address with them, such as additional warehouse space may be necessary, additional equipment may be required, additional CapEx may be required to fulfill orders. But to answer your question directly, it's a variety of companies. I have urgent cares that have seen a 100% increase over previous year because of now they're offering COVID testing. I have companies that were distribution, and now they have more of but their retail space now turned into more of e-commerce, and now they've seen great growth.
Wonderful. I mean, it's just interesting times, that's for sure. And so I want to bring back John into this discussion, and I know he has a couple of stuff that's been and some questions that's been popped up. And so, John, you want to go ahead and take over?
Yeah, thanks, Gary. We have a couple of questions that came in on our Q&A. Let's see, so for the lenders. The first question here, what is the interest rate for a commercial loan? Anybody want to take that?
Yeah, I can provide some feedback on that. Again, what I specialize in is the SBA 504 loan program. 90% financing. It's a two-part loan, 50% financed by the bank, 40% financed by the SBA directly. So on my portion of the loan, any loans that we're funding this month is at that 2.56 fixed for 25 years on a commercial loan for real.
Okay.
For me, owner user property, a standard 1025 is around 4%.
Okay.
And my answer would be, it depends on the project. It could be as low as 2.5%, or it could be as high as 5%. You know, every transaction is unique. Every structure is unique. It's a matter of having a discussion and understanding what's the right structure. Therefore, thereafter deciding what the right rate is.
Okay. All right, and you guys have kind of already addressed this, but it is a little specific that somebody put in. How much of a down payment is required for an owner-used commercial lot, no structure? So, for example, a car lot.
On the SBA side, if it's for transportation, like a trucking company, logistics company, and if they need it for parking, the SBA is okay at 10% down or 90% financing. If it's a car lot for someone who's selling vehicles, that will be considered special purpose and it would be 85% financing, 15% down.
Got it. Either of you guys have any input on that, or?
Well, in our case, it would really depend on the financial capacity of the sponsor.
Okay.
We're not typically looking at raw land deals, but we will finance them. The percentage would probably be lower. My guesstimate would be around 50%.
Okay. All right. And then lastly, to wrap everything up, you know, obviously the focus here is, you know, things are very uncertain out there. So maybe if each of you can take about 30 seconds and kind of give your best advice to business owners out there and what they can do to, you know, best position themselves, you know, in the market today and help them from a finance position. So I'll start with Rick. Oh, no, Golly, go ahead.
Oh, sorry about that.
No, that's fine.
My recommendation would be is if you haven't had a conversation about your current building to see where the rates are currently, I would pick up the phone right after this call and see what you can do. Subsequently, be prepared. There will be more questions asked now than last time you refinanced or purchased a building. You maybe require some additional documentation. And lastly, the process will take a little bit longer than initially did, but it's worth it because the rates are historically low.
Great. Michael, you want to go, or Rick?
Okay, so one thing to keep in mind is that your banking relationship matters. And so anything that you can do to help communicate what you're trying to achieve, anything that you can provide to support the request would be valuable. And we like to do business with people that we know. So I would start with your existing bank and see what they have to offer. And then, of course, as Ollie said, you could take it out to the market as well to just make sure that they are within a reasonable interest rate.
Great. All right.
And just to add on that, for anyone looking to purchase, refinance, and I believe what this applies whether to owner user or if it applies to an investment property. The part that I'm seeing that is taking time to accumulate is understanding the business cycle during COVID. So given that we're ending October, starting November, a lot of lenders are going to want to see how your business did in the months of July, August, September, October, now going into November compared to last year, because they're going to want to mitigate maybe that decrease in overall sales. But again, you may be having a month-over-month growth in this quarter or this period versus the time period last year. However, overall sales may be down. So it's real important for a lender to understand that, to show that COVID truly was the reason why your business did struggle during those months, and you've rebounded. And that's usually the success where you're finding lenders moving forward with processing of your loan requests.
Great. Okay, well, that finishes up our time. I want to thank Gary for a great presentation. Thank our lender panel, Rick, Mike, and Ali for providing some great insight today. I want to thank all of you attendees out there for joining us, and I hope everyone has a great day. Thanks a lot, everybody.
Thank you, guys.
Thank you, John.